And welcome to the Smart Money Simplified podcast with your host, Brent Mikosh. Brent, good to be with you again. What you got going on this time around?
Bill, I'm pretty excited about today's conversation. So I think that oil and gas industry and the energy space in this country, it's a hot button issue. You've got a lot of people on one side said we got to cut off production of oil and gas. You have people like myself, quite frankly, that believe that, the energy complex is really the lifeblood of Western civilization. It is.
Yeah.
And I think that it's been been a really interesting spot in the last couple of years, to say the least. I've got a great guest on. I've got David Messler on. He can tell a little bit about what his background is, but this guy is an oil field veteran. He's been in this industry for 38 years with some major companies. He's also done some consulting. He does a lot of stuff, so he's got a lot of knowledge in this field. So with that, I'm going to introduce Dave. And Dave, you want to share a little bit of your background and how you got into oil and gas?
Sure, glad to do it, Brent, and appreciate your having me on your podcast. It's a real pleasure. So the oil field has been the bulk of my working career since I got out of the military in 1977. I finished up college, and then in '81 I fell into the oil patch, and spent most of that time working completions, which I might define a little bit as we go along. There's the half of the job is making the hole, and then the other half is figuring out what you're going to do with the hole once you've made it, and that's the completions phase. So I've been a completion specialist my entire time, and directly or indirectly worked for Schlumberger most of that time. Knocked around the world a good bit as a drilling fluids specialist, completion fluids, clear brines, and then have just basically, in the early 2000s, I worked in-house with BP, and then I went down to Rio de Janeiro and worked in-house with Shale on one of their deep water projects. In Brazil, I've worked the North Sea. I've worked down in Australia. In fact, you would have to go down to Antarctica to find a continent that I haven't at least changed a plane on. So my background is an area of specialization called reservoir drill-in fluids, which are purpose-built fluids designed to minimally impact the reservoir as it's drilled when an operator is planning an open hole completion. And that kind of finished up my career. In 2015, the downturn got me. I was only 62 at the time, and I said, I'm not quite ready to hang up my spurs. So I started a training academy to teach young engineers how to design reservoir drill-in fluids and attendant chemistries that go along with that. And then I've also done some consulting, and then started my career writing articles on oil and gas companies and along that line. So that's me in a 2 or 3 minute nutshell.
Well, I've read a bunch of your work, obviously, on, I believe, Seeking Alpha. You've been on there, oilprice.com. You're a contributor there as well. And,
exactly.
I guess a good place to start is looking at the current state of the industry. You mentioned the downturn in 2015. Obviously had, huge degree of investment that kind of ended about 10 years or so ago. And now we're looking at sort of the repercussions of that. You had a few things where, you don't have a lot of new capital moving into this space right now. A lot of the ESG constraints have for sure put the brakes on development as well. How would you summarize what the current state of the oil patch is right now, specifically? And I guess my view of your knowledge base here was far too limited, because you're telling me all these places around the world that you worked, and a lot of the stuff that I've read that you've written is on the Permian. So we can kind of start there and move out. What's the state of the industry right now here in the U.S. and around the world?
Well, we're in a fairly mature stage of consolidation. You almost can't pick up or open a link, and nobody picks up a paper anymore. I don't know what I was thinking. Where you don't read about one oil company buying out another oil company, either through a share exchange, or paying out a private equity firm to get their property. And the driver behind this is we're about 15 years into the shale. I guess I'll call it a miracle, because for 100 years people drilled through shale and then put it behind casing because they didn't know what to do with it. They knew there was oil and gas, but the technology had not evolved to the state where they could do anything about it. Horizontal drilling and fracturing solved that to a large extent, and was proved out in the early 2000s, probably beginning in 2008. If you go back to 2006, there was about 1 million barrels a day of U.S. onshore production. It's just been falling year after year because the best spots had been drilled up. And with horizontal drilling, you can start to see that it climbs year after year. There's this big influx of drilling rigs. At one time, there was close to 5,000 rigs turning to the right in the various shale basins. And then, when pricing falls, you lay down the rigs and try and evaluate where you are in terms of the price that you can get and the amount of money you can spend, and then go back to drilling when things look a little better. But today, on the financial side, companies are jockeying to get the best rock, to get the best drillable locations. And I guess while we're talking about the Permian, and if I digress too much, please get me back on point here. I sometimes will go off on tangents that I get interested in, thinking everybody else will be interested, and lose track of where I am. That's called a senior moment.
Or it's called a heck of a lot of knowledge that you're trying to convey. So.
And thank you for that. That's very generous. But the Permian is the Permian because of the way that it was laid down geologically about 300 million years ago. We have these rich sediments that were accumulated in what geologists call a lacustrine type setting, and that's a very shallow marine environment that is sustained by wind-driven and water-driven sediments that do not experience a lot of turbulence or mixing as they settle to the bottom. And that's where we have the shale layers that come from now. As these sediments accumulated over time, they become compacted, and the Permian has the Wolfcamp A, B, C, and D benches, as well as the Bone Spring upper and lower. Those are the primary targets for oil companies. So the beauty of the Permian Basin is that an operator can drill a lateral well. He can have multiple targets from a single pad that they use to drill from, and so it greatly increases the economics of drilling to have that type of optionality, I guess is the term, available. Do we complete in the Wolfcamp A? Do we also complete in the Wolfcamp B? Or do we just save one for later on?
So the way I'm visualizing this for a layperson like myself, you're talking one wellhead basically, but then you have the ability to drill it down and branch it out at different levels.
It's called a multilateral.
Got it.
And you see a lot of that. There's several ways of going about this, but that's the optionality that the Permian gives you. And then you have the cube style of development, where in order to minimize well harmonics, and that is the impact that drawing on one well has drawing on an adjacent well, you may put several wells with spacing in the Wolfcamp A, several in the Wolfcamp B, and have a cube style of development in that fashion.
And now, what's the state of the industry there now? Because I know my understanding in the past, obviously, the oil business has been a lot of boom and bust. through the 1970s into the early 1980s, and then of course we had another one here in the middle of the last decade. How do things stand right now? Because we're seeing oil prices are beginning to surge again, but we're well off the highs that we were at just a couple of years ago. What's the feel there now?
Oil companies are much healthier than they were 5 years ago. The previous model was to borrow money, pick up as many rigs as you could possibly obtain. Rig building was going through quite a new generation as well, and just punch a bunch of holes in the ground, increase production 15 or 20%, compounded annual rate of growth. CAGR was always a term that everybody used in their proxy materials. And all the cash flow went to operations, to capex, and then investors were not getting much in the way of return. If you go back and look at companies, Devon, PXD, whatever, they had very paltry dividends. They weren't buying back their stock. Everything was going into the ground. And then the Great Reset came along in the late teens, 18, 19, where the balance sheets were bloated, and the banks who had no problem funding shale at the time said, hey, we need to return some capital. And so it set about a new mindset, and then we hit a bottom there in 2020, and then things began to rapidly expand from there. And by 2022, companies were announcing all these shareholder payouts and capital return that made them attractive investments. So they were going from a growth type investment to a yield type investment, although investors are finding out now that chasing yield can be risky. But your core question is the state of the industry, and what's happening is big companies are gobbling up little companies. And what happens in a mature phase of an industry is there's just too much competition. There's too many companies out there. The one thing about shale, and I'll try and tick them off, about 4 or 5 years ago, I came up with a 5-point reference list of what it would take to be a long-term survivor in the shale business. And it was, being low-cost producer, being able to scale your operation, superior logistics. But that was all underpinned by having the absolute best rock. And I could spend the entire hour talking to you about why certain sections of the Permian Basin up in Lee County, New Mexico, and Loving County, Texas, the thickness of the reservoirs is many times, as the way these things accumulate, they're somewhat lenticular. So you get out beyond these core areas in these counties, and the sediments get much thinner. So the opportunity is to make big wells is less. So you see companies trying to accumulate what are termed all these tier 1 locations. You may have heard that term before, and that describes an asset with good total organic carbon content, a permeability. Permeability is the natural ability of rock to flow fluids, and a porosity, which is related to that. And these are the wells that will cost the least amount to drill but deliver the greatest amount of return. So that's your tier 1, and is probably best described as the Wolfcamp A and the Upper Bone Spring. And what's happened over the last couple of years, two things happened. With the oil price below $60 a barrel, companies brought forward a lot of their tier 1 drilling locations if you think about it, when the oil price is low and you want a return on your capital investment, you drill your best rock. And so now with oil prices higher, they're looking back at their tier 2 and tier 3 because they've become economic. So we're drilling some tier 2 and tier 3 rock, but in the back of their minds, oil companies would love to have as much tier 1 rock as they can get. So this is really what's driving the M&A cycle that's underway right now. You know, if you Exxon Mobil and PXD, excuse me, Pioneer. I talk in 3-letter.
We know most of those symbols, so you can definitely use stock symbols.
Anyway, but so they've agreed to tie up, and if you dig into the reason why that, Pioneer has, you know, top tier operating margin, top tier recycle ratio, top tier ROAC, and Exxon, you know, they made this big splash a couple of years ago. Oh, we're going to grow to 1 million barrels a day in the Permian. Well, they're about halfway there. So Darren Woods has a problem. You know, he said, hey, you know, by 2027 we're going to be producing 1 million barrels a day. Well, you can get there by drilling, or you can get there by drilling on Wall Street. Right. And that's what we have. But to summarize the state of the industry, it's in a consolidation phase that's going to continue on for a while.
Now, let me ask you this, and one thing we can't do, I've got a wonderful compliance department with Raymond James, my broker dealer, but we can't make recommendations for, you know, individual securities and things like that. However,
no.
You wrote a very interesting article, post, I guess, a week or so back, on looking at, you mentioned Pioneer, you also mentioned Devon Energy.
Yeah.
One thing that I've tried to figure out, quite frankly, is there's been a big discrepancy in how the performance of those two stocks has been over the course of the year. Devon is obviously, they've both been down, and it's been tough being an energy investor this year. But Devon's significantly underperformed. What's your take on that?
Well, it's interesting. Without making any sort of recommendation at all, because I'm not licensed to do that. Devon has some great rock, and they're making terrific wells, but their Delaware Basin, which is a sub basin of the Permian, is very gassy. And if you look at gas prices, they've really suffered this year, right? So that's really impacted their profitability as compared to companies with, like Pioneer, with a more oil-weighted basket of production. And Devon has taken some steps to increase their oil weighting. They went out and spent $1.9 billion on a private equity firm, Validus Energy, to get in some of the best places in the Eagle Ford. And the idea there was to increase their oil weighting. Sorry about that.
No problem.
When you're done there, you can just pick up the answer right before you got interrupted, and we'll fix it and edit. Don't worry about it.
Okay, good. Yeah, I meant to silence the phone, and then I dialed in instead of doing that.
No worries.
So. Okay. Yeah. So yeah, Devon is you know, they have that problem out in the Delaware. You know, the gas cut's pretty high, and it's getting higher. If you look at the Permian Basin, if you the EIA report, the drilling productivity report, which comes out monthly, breaks down the oil and gas production of the 8 major shale basins. And if you look at that report, it comes out Monday, as a matter of fact. You'll see that the Permian over the last 5 years has gone from about 12 BCF a day to 23 BCF a day. It's grown faster than any other basin, and it may someday challenge the Marcellus for the amount of gas being produced daily. So, and this is just a function of the tier of rock. The tier 1 rock, it trended to oil. Tier 2 rock is deeper and hotter. And when you look at a thermograph of hydrocarbons, as you increase the temperature, they start to turn to gas. And this was very predictable.
Yeah, that's an interesting interesting thing to consider in terms of what's the byproduct, because obviously you're going after the oil, but for years we've flared off gas, and now there's some value to it. But the value, obviously, on the gas side's been down significantly over the past year or so.
Yeah.
Let me ask you this: so we've got current administration is probably a little less friendly toward fossil fuels than previous administrations. From a regulatory standpoint, how much of an impact has that had on the oil and gas business in Texas and beyond?
Well, it varies company to company, and it has more of an impact in New Mexico than it does in Texas, because most of the operators in Texas are not on government land, whereas in New Mexico they're on government land. So that gets a bit tricky, and of course, it probably. You framed it in a very kind and gentle fashion when you say they're less friendly. Some might say antagonistic, but let's not go there. So yeah, it's concern, and it's part of the reason that you're not seeing more of a response. Everybody said, well, when the oil price gets back to $90, we're going to pick up rigs. Well, we didn't. We dropped rigs. Why is that? Part of the reason is if you're running an oil company right now, the administration is, every time they're on TV, we're going to put you out of business. We're going to put you out of. Oh, but would you produce more oil today? They want their cake and eat it too. How do you run a business that way? It's tough, and so there's also, kind of, and this might be a good segue in the conversation to talk about how technology has changed the dynamic for shale operators, to where we're producing 12.9 million barrels a day today with about 550 rigs turning to the right. Now, if you go back 5 years, there were 1,200 rigs to produce about the same amount of oil. So what's happened is we've become much more efficient. We've applied technology in probably the two. We're better at finding out where the oil is, and when you're planning a well, particularly a horizontal well, you're starting out vertical, and you want to put the landing zone in the area of greatest permeability, and then go out horizontally from there. So we're better at AI is helping us to become better at imaging the reservoir itself, and then over time the fracturing companies have gotten much better at carrying out the fracturing task. If you go back a few years, Liberty Energy, which is one of the big independent fracking companies in the country, was doing maybe 10 stages a day. Now they're doing several multiples of that, and that's just increased efficiency. We now have super spec rigs that can walk from one location on a pad to the next, and so that's cut a lot of inefficiency out of the operation, to where operators just don't need as many rigs to produce the same amount of oil.
You wrote a Diamond article on that on oilprice.com. Article was, for listeners who want to look it up, is how technology is driving innovation in exploration and production. And I think the cool thing is you're seeing it across multiple industries, and specifically yours. the ability in healthcare, for example, there's a limit to how many images a doctor can take a look at, for example, and you learn something new every time you see those images. In your business, the amount of data on the geology that's coming up is absolutely enormous. And when you can use artificial intelligence to sift through that data and power through it and compare rock formations and what they've yielded in the past, not just in the Permian, but maybe around the world. And I would imagine, and you're confirming that to me, that the impact on successful drills and successful exploration has probably been astronomical in terms of what that's added to the equation.
Well, and another interesting data point. There's another EIA report that comes out that show. No, this is still the same report. It's the drilling productivity report that comes out monthly, and it tracks the amount of oil produced per rig, and it's a very simple calculation. It's total production by the number of rigs, but what it does, it gives you a trend. And if you go back, recently I went back and looked like 3 years ago. In the Permian Basin, we were making about 1,250 barrels a day per rig. And if you come to the most recent edition of the drilling productivity report, we're under 1,000 barrels a day per rig. So there's a decline in the quality of the reservoirs, and that is tied into the M&A cycle that we're in as well. Is companies are struggling to maintain output, and they're looking for the best rock to help them do that.
How much of that rock is left in the Permian? I mean, is this a resource that is relatively exhausted, or is there still a lot of life left?
Well, estimates vary, but my own research and from talking to other people in the industry is we've probably got between 3 and 5 years worth of tier 1 drilling locations left. Now, some companies will have more because they've made timely acquisitions and increased their bank of tier 1 drilling locations. But in terms of where we started 15 years ago and where we are now, tier 1 drilling locations are probably between 70 and 80% drilled up.
And so the result for the end user is going to be there's still going to be plenty of oil and gas that comes out of there. It's just going to be a heck of a lot more expensive to get it.
It is going to be more expensive because technology is not cheap.
Right. And
I'll give you another example. When we first started fracturing, they were only drilling probably 6,000 feet horizontally. Now we're drilling 12 to 15,000 feet horizontally. So that's more contact with a rock to produce oil. When we first started fracking, we were only injecting about 500 pounds of sand per foot of interval. Now, routinely, we're injecting 2,000. Some reservoirs we're injecting 2,500. Some reservoirs up in not the Denver Julesburg, but the Marcellus. They're injecting 3,000 pounds of sand per foot of interval. If you multiply that out by 10,000 feet or 12,000 feet, there's 20 or 30 million pounds of sand being injected. So the costs have gone up, and they're only really sustained by these higher oil prices.
Right. Now, a question for you in terms of what's going on geopolitically around the world right now. Obviously, over last weekend was when, and just for future reference, we're recording this on October 12th. It'll probably be the end of October by the time we release it. But it was obviously the invasion into Israel that we had from Hamas, and there's questions of what Iran's involvement was. You have, I guess, the Ford is currently in the Mediterranean. I think the Roosevelt's on its way in. So who knows what is going to happen when things erupt in the Middle East. I mean, last time in the past, you look at 1973, I think it was the Yom Kippur War, and you saw an explosion in oil prices after that. What now it's as new news for us, obviously, but what are you hearing among the people in your community, in the oil and gas community, about the readiness of the United States, if need be, to ramp up production? Because we're also in this phase now where we've emptied the strategic petroleum reserve. You know, we've got what, 17, 18 days left of fuel in this thing. It's the lowest level it's been in 40 years. So
Right.
what's the chatter around that among your circle?
Well, you know, the flare up over in the Middle East is still so new that I don't know that people have really assimilated. We've seen the oil price fall off pretty rapidly from that initial, you know, $2 or $3 a barrel bump. And that's very typical with what happens in a belligerency type situation. People get all concerned that no, they're going to start blowing up oil rigs. Well, they don't blow up oil rigs. That's just not what seems to happen. If you accept perhaps the Kuwait invasion back in the early 90s, I guess. So the problem the United States has, and as you correctly point out, we've drawn down our reserves. Global reserves are also at a very low level, so there's a thin margin of supply immediately available that's only really maintained by what has been surging production here in the U.S. You know, we've been adding, you know, probably 100,000 barrels a month for the past 8 or 9 months. We've gone from, you know, around 12,000 to 12,900 barrels a day. Excuse me, 12 million. Had my zero in the wrong place. So it's kind of a precarious situation that people won't really know how bad it can be until things do start getting blown up in the oil field. This very expensive, you know, architecture, very difficult to replace if that comes to pass. And the response, you know, if we had to add another, you know, 100 surface rigs or land rigs, we could probably do that. But beyond that, you know, we would be building new rigs, and nobody's building new rigs. When you read the quarterlies from the drillers like Helmerich and Payne, Patterson, UTI, and you get into the weeds of it. Are you building it? No, we're not building any rigs. We're upgrading rigs to super spec, to where, you know, where they can walk on these pads and not have to be completely demowed. But new rig building is at a complete standstill. And from a personnel aspect, it would be very difficult to respond. You know, with the low unemployment rate right now, it's hard for the oil field to attract workers. You know, we have such strict standards. You know, you can't have anything on your driving record, any you know, any sort of violations, or they just can't put you in the field. So, you know, there's somewhat self-limiting in that regard. So people are a resource that's very difficult to come by.
Well, let me ask you this, and you may or may not know the answer to this, but I'd heard something recently. I might be wrong, by the way, but it kind of surprised me. That in many cases, at least what we're paying for diesel or for unleaded gas here in the United States, that bottleneck is often the refiners. And my understanding is that most of our refineries are built to refine grades of imported oil, not necessarily what we're pumping here. And it's very obviously, you know, we talked earlier about why would a company invest in a business you're being told to be put out of business. And even, you know, we haven't built a new refinery in this country since the late 1970s.
Right.
Even if you wanted to, we're talking you're into the billions probably in production costs, 10 plus years minimum to get all the permitting and everything like that in place. In the event of an embargo, let's say all of a sudden, because that's really wasn't the fact that, you know, that production facilities and things were being blown up, you know, in the 1970s, the Arabs just decided they were going to do an oil embargo. What is in terms of our refining capacity, are we dependent on Saudi crude? Are we dependent on Venezuelan crude? Can we exist on the kind of oil that we're pumping here in our own country?
Well, that's a great question. I'm going to pleasantly surprise you with part of the answer, and then perhaps depress you with the other part of the answer.
Okay.
There's never a perfect answer.
Yeah.
So the problem with the crude being produced from shale is it's very light gravity. It's 40 gravity and above. It's usually somewhere in the range of the mid 40s, maybe even to 50. The breakover once you get to 50 gravity, then we call it condensate. And the bulk of shale oil is light gravity. And for you, as you correctly point out, we haven't built refineries in decades, and they were all built to run on imported oil that was heavier gravity. So where we do need help is from countries that supply heavy oil, like our Canada is. We are currently getting more oil from Canada than any other country. 62% of imports come from Canada right now, and what we're buying most of is the heavy oil sands material that's actually thinned out with NGLs and condensate, so they can pump it. Then Chevron has started pulling heavy crude out of Venezuela. So you mix those two things in the refinery, and you get an optimal blend of gasoline, diesel, heavy fuel oil, jet fuel, and things like that. So we're not as dependent on Saudi as we used to be, but we are dependent on imports to get our blend stock to where our refineries can run efficiently.
And what's the talk too, and diving more into the geopolitics, because the oil business is really at the center of a lot of it. You now have a lot of talk with the Saudis, which used to be very firmly in our camp, are now opening a lot of channels with China in terms of perhaps pricing their oil in something other than U.S. dollars. What are your thoughts on that? I know I'm pulling you away from the engineering side of thing here, but as someone with vast experience in the business, I'm just curious what the chatter is around some of these issues.
Well, I think it's a natural progression or maturation of Saudi as a society. They've learned over time that raw resource suppliers usually do not reap an appropriate share of the rewards. The price of the oil is one thing, and so they're looking to broaden their industrial base into other areas, and so I think it's only natural that they reach out to other geopolitical powers like China, Russia, Iran, because oil is fungible. They can sell it. They can sell it to anybody, and I think it's probably a sign of the current state of upheaval is what I'm trying to get out in the world order. The world order is changing, and the 20th century was the American century. It remains to be seen who will claim the current 21st century, I guess we're in now. But oil is going to, and I guess I might pivot just a little bit into what is the future of oil.
Yeah, that was you read my mind, because that's where I wanted to take it. Yeah.
Yeah. So oil, there's no scenario that I've read where we use less oil or gas in 2050 than we do now. we will use 10 million barrels a day more in 2050 than we are now. And that may have you scratching your head, but green energy is going to displace all of that. Well, no, it's not. Yeah, that goes against the popular narrative that solar and wind and all of these things are going to displace oil and gas, and we just won't need it anymore. You know, chemical energy is direct energy. All these other forms of energy, we're taking energy and converting it in some fashion, and you lose something in the conversion. It's just simply not as efficient. It's not as reliable. For every solar farm you put in, you've got to put in expensive batteries that, you know, in the best case I've read, there's this huge solar farm that's putting in, I forget how many kilowatts of battery, but it's only good for 24 hours. What do you do then?
Right.
Yeah. So you have to have natural gas as a backup if you want plastics. You have to keep producing oil. Oil is gasoline is an optimal fuel. Diesel is an optimal fuel. People are driving themselves crazy to find vegetable oil based fuels to replace petroleum products and burning petroleum products to produce them. I mean, it just one of my favorite pet peeves is all the ethanol that's produced to blend gasoline. It's burned using diesel anyway.
Well, you bring up an interesting point, and I think the one thing, and you know, we all want clean air and we all want clean water and all that, but when I look at some of these alternative energy sources that are discussed, the big exception being nuclear, but the input costs to generate that windmill, you know, my understanding is for a lot of these industrial sized windmills, it's 7 or 8 years of production that mill that fan has to put out there just to compensate for what it took to mine the materials, to move it, to get it there, to build it. And the useful life of these things are 9 or 10 years, you know, so you're kind of like, you might be really clean over here, but you're really dirty to get to that point. And I think that, I think that it seems to me that that people are starting to look at maybe what the entire cost of some of these alternatives is. And
if I may, Warren Buffett
please.
has a great quote. You probably know this quote, but it's one of my favorites. And he was asked by someone about investing in wind farms, and he said the only financial basis for it are the government tax credits. You take those away and it falls on a face. That's not a perfect Buffett quote, but that was essentially what he said. Without government underpinning and support, there's no business case for these things.
Yeah. Well, you know, you're in a fascinating business, Dave, and I really appreciate you spending some time to talk to me about it today. And please, let's keep these lines of communication open, because it's an obviously very changing landscape that we're in, and the business that you are educating people on is a very important one.
Well, thank you. It's been my pleasure. I'm a natural talker. I love to hear the sound of my own voice, so I appreciate you having me on, Brent. It's been my pleasure.
I really enjoyed it. Thank you.
All right, take care now.
That was great. Thank you very much, Dave, and thank you for facilitating that conversation, Brent. If anybody's listening who doesn't know how to get a hold of you, how can they reach out and perhaps have a further conversation with you?
Yeah, that's a great. Let's redo that exit.
Okay.
So we're going to editing team. We're going to go back. Where we leave that, Bill, in terms of future. I basically said something about the wind farms not being productive and everything else.
Yeah.
All right. I'm just going to pick it up and go from there. And I also do, when we get done this, I want to redo my intro. So we cobble these things together sometimes, Dave.
Sure. No, I understand.
the end result sounds a little bit better. The YouTube piece, I always put up the YouTube of this kind of stuff though, because I think it's kind of amusing. But so let me start with that. So all right, editing team, we're gonna pick up from here. So Dave, you offered some really amazing insights in your industry, and first of all, you know, if people want to know more about your work, because you're contributing quite a bit to various different sources. I mentioned before oilprice.com. I've seen some of your stuff, I believe, on Seeking Alpha. How do people find you?
Well, on Seeking Alpha, I am known as the Fluids Doc, as you will recall, that my career was in fluids. And so if you search Fluids Doc on Seeking Alpha, you can find my work. You can then, I also have written for Oil Price over the past few years, and I publish there under my own name. So those are two places that someone could go.
And I highly recommend, if you're curious about this business or you want to know more about what's going on, definitely look up Dave's work and read it for sure. You know, I've learned quite a bit. And Dave, I really thank you for taking time out of your day to join me.
Been my pleasure, Brent. Anytime. Thanks so much.
No, thanks to you both. One of the most important conversations we can have today, or any day, actually involves energy, because it is the most basic fundamental commodity that is necessary to life as we know it. So, Brent, thank you for facilitating that conversation today. We know how to get a hold of Dave. We know how to get in touch with his work. How do we get in touch with you if we want to have a further conversation?
My easiest way is in terms of social media, the only social media platform I'm on, but that I'm most active on is LinkedIn. So you can just search me on LinkedIn. You can call us here at the office. It's on 602-255-0555. Either myself or Andy or Susan or Kayla is going to pick up the phone. They're fantastic. My team knows how to get a hold of me at all times. Or you can just go to mpadvisorsaz.com or smartmoneysimplified.com and you can find us online.
Sweet. Thank you very much. And listeners, thank you very much for taking the time to listen to this conversation. We hope you found it useful and informative. If you are not already a subscriber, look, hit the button. It's easy. Hit the subscribe button. Then you don't have to remember where you heard it. You don't have to remember how often he puts these episodes out. It will be delivered to you. You'll get it, and you'll never miss another episode. And if you like it, we humbly ask that maybe you take some time to rate it, share it with other people, get the word out about the podcast. Thank you so much for listening. On behalf of Brent and everybody at MP Associates, thank you for listening. And if you don't know already, you should never wait. Live your best life today. Thank you. I'm going to keep that recording going.
Keep it going. Yeah, I want to redo that intro because it was kind of
Okay, I'm going to sign off, gentlemen.
Okay, thank you, Dave. We really
All
appreciate
right,
it.
thank you, Bonner.
Break our hearts, man. But thanks for that. That was good.
All right, you bet.
Appreciate it. Thank you.
Okay. Whenever you're ready.
All right. So you want to do a welcome to, hey, Brent, what's your
Oh,
normal
okay,
intro?
sure.
Yeah.
Yeah.
We'll just do the whole thing.
Yep. We'll do the whole thing starting in 3, 2, and welcome to the Smart Money Simplified podcast with your host, Brent Mikosh. Brent, good to be with you again. So what do you have in store for us this episode?
Well, let me tell you what I did this morning. I woke up, turned on the lights in my house, and fortunately they went on. Had some breakfast. I got in my vehicle, started the engine up, drove here to the office. I've walked into my office here. I've had my computer fired up all day. We live in the desert, so we got air conditioning running. We've got the lights on, the computers are on, the phones are on. It's all good. But here's the one thing that I really consider every day. I'm very passionate about the energy business. I think it's a business that has kind of been a little bit of crosshairs for people lately, and I think that then you need to consider that a lot of our modern life, particularly here, not just in the West, but around the world, really, it depends upon cheap and abundant energy. I turn on my car, I need a full gas tank. You turn on your lights, the power plant, whether it's running on oil or whether it's running on natural gas or nuclear or coal, even in some cases, you need a society as advanced as ours needs cheap and abundant energy. And so it's an area I'm really interested in. I've got a great guest today. I've got David Messler. And so David Messler, he's an oil industry veteran. He's worked for major companies throughout his career. He's got a 38-year career. He's centered in Texas right now, but I think we're gonna learn a little later on in this conversation that he's got quite a bit more experience, as I learned when I did some research on this. He's a contributor to oilprice.com. I've read some of his work on Seeking Alpha, and he's just he's a really a guy that's really deep in this business, has a lot of insights to offer. So we're going to talk about some great stuff today. So with that, David, thank you for joining us. Is anything you want to add to my introduction?
Gonna stop the recording there.
Ed team, pile that in the beginning.
Yeah.